All right, so if you've been wondering what's going on with rates, where they're going, what will it look like by the end of the year, this video is for you. So stay tuned for a short video on what's going on with the rates through this year. Hey, so here's a quick rundown of what we've been seeing in the markets over the past week or so, and some insights on what we might expect to see as we make our way through 2023. So on Wednesday of last week, February 8th, the FOMC raised short-term interest rates by 25 basis points, which brought the federal funds rate to about 4.5 to 7.5 in that range there. And the 25 increase was expected, and the markets welcomed it with open arms. So stocks and bonds both rallied nicely, and when Fed Chair Powell took the stand for his press conference, he very calmly and confidently reiterated his part. And he reiterated the mantra that the higher for longer is kind of what we're going to be seeing. So that equates to the federal funds rate being around 5%, followed by a prolonged pause before starting to bring rates back down to a more normal level. Remember, the Fed wants to get it around 2%. So we're starting to see the light at the end of the tunnel when it comes to rate increases. So the length of the pause is what really markets are trying to currently figure out. So we've seen inflation numbers coming down month over month, with the 2022 massive federal funds rate increase still not being fully digested through the economic system. Wall Street's really having a hard time believing that the Fed won't have to cut rates due to recession-related worries later on this year in late Q3 or Q4. What we've got here is essentially a game of chicken between Wall Street and the Federal Reserve. So every major economic data release is so important in trying to piece together what the Federal Reserve's timeline puzzle is. So it's no surprise what we saw was a pretty significant market sell-off after that super smoking hot jobs report we had last week on Friday, on February 10th. January's non-farm payrolls, that number came in at 517,000 new jobs compared to only 187,000 that were expected, and the unemployment rate fell to 3.4%. This is the kind of report that really plays into the Fed's hand. It becomes easy for them to justify more rate hikes and a longer pause. It also shows that our economy is really resilient and the recession risk might not be as prevalent as markets are maybe expecting or pricing in. So far in 2023, we've seen a calmer mortgage-backed securities market, and we all know that's kind of the 10-year Treasury bond that we follow. So the range of the 10-year Treasury has been pretty tight, with a high yield number of 3.75% and a low yield about 3.4%. So we're actually staying in that area. So like I said before, inflation data has shown that it's coming down, which has helped keep things a little less volatile. Along with improving inflation, we have a relentless Federal Reserve who seems hell-bent on achieving at least 5% federal funds rate, followed by a lengthy pause, even if it really means getting into a recession later in the year. So let me put it this way. The one thing we know is that the Fed would rather risk a recession than have inflation rear its ugly head again. Now, it might be wishful thinking, but in my opinion, cooling inflation numbers and aggression from the Fed will continue to force Wall Street to price in an upcoming recession, which should in theory then mean interest rates will improve. Now, we shouldn't be surprised if the data-driven knee-jerk sell-offs like the one we just saw last Friday's job report, but it's really, in general, the trend for 2023 will be that rates will continue slowly improving towards the mid to low 5% area on the 30-year fixed mortgage.